Okay, let's continue on with looking at some ratios. Here we have the earnings per share of common stock. This is a very commonly looked at number for investors. It is required by GAAP to be on the income statement. So at the bottom of the income statement, you will see, and we will learn later this semester on what we need to do to put the earnings per share on the income statement itself. Okay, and so the formula for earnings per share is to take the net income that's available to the common stockholders. So this is any net income, and we're going to subtract out preferred stockholders, whatever dividends that they are allotted to has to be paid out before we can give any dividends to common stockholders. So we're going to take the net income from the income statement, subtract out any dividends we owe out to preferred stockholders, and then the rest of it would be available to common stockholders. And we're going to divide that by the average number of common shares outstanding. So we can issue out common stocks from the company, and let's say we issue out 100 shares. Let's say that we decide to buy back, the company buys back 20 of those shares. Then we call that treasury stock. So there's actually 80 shares now still left out in the hands of the public. 20 shares that we've brought back into the company. So this outstanding means the shares that are out in the hands of the public. Okay, and so that would be the 80 shares in our example. Okay, so this is the average number. So we have to look over the course of the year. If January 1st we started with 100 shares, and then in June we bought back the 20 shares, but then in October we issued another 50 shares. Okay, so what you're looking at is the average number of shares for the year. Now, if we started out with 100 shares and nothing happened, and we ended up the end of the year with 100 shares, then that would be the average, is 100 shares. Okay, so now for French connections importers that we've been looking at, these analyzing videos, they didn't have any preferred stockholders, so all of their net income was available to common stockholders, and they didn't have any changes in there, or if they did, this was already computed to be 6,750 average shares. So we take the net income divided by the average number of shares, and that's $10.64. What that's telling us is that if we took all of the net income and divvied it out amongst all of the public investors, every share would get $10.64 dividend. So, of course, the company is never going to divvy it all out. The whole point of the net income is that we want to resock some of that back into new assets so that we can make even more sales, so that we can grow, okay? And so never is all of it going to be handed out to these stockholders. But what this earnings per, and everybody realizes that, but what this earnings per share says is, if they did hand it all out, how much would I get per share? Okay, and so if I had 2 shares, I would have a little over $21 in dividends that I would get. Okay, in 2011, we took our net income from 2011 divided by our common shareholders from 2011, 6,000 shares that we had outstanding, and that equals $9.13. So when you can see that the earnings per share went up from last year to this year, that is a sign of growth, and investors look very favorably on that. And so this earnings per share, by the way, is oftentimes called EPS, earnings per share, EPS. Okay, very, very common thing for investors to look at. Even though they know they're not getting that amount of money, they just want to see relatively, is it going up or down? How does it compare to other similar companies? Okay, that was the last of the profitability ratios. Now we're looking at the leverage ratios, and this is looking at comparing our liabilities and our equity, indicating the extent to which the company is being financed by debt or equity and the ability of the company to meet its debt obligations. Okay, and so here I just have a couple of these we're looking at. There's more than this. The ratio of liabilities to stockholders' equity, also called the debt to equity ratio, and the times interest earned ratio, which is a ratio that bankers and loan officers often take a look at this. So here's our ratio of liabilities to stockholders' equity, or our debt to equity ratio. We just take the total liabilities. This includes current liabilities and long-term liabilities. Total liabilities, and divide it by this total stockholders' equity section. Okay? And so we get 0.62. We put that into a ratio, so we would put a colon or the word 2 and then a 1. Okay? And again, the 1 goes to the denominator, and the first number goes to the numerator. So this is saying for every $1 of equity, we have 62 cents of debt. Okay, so that means we have a lot more equity than what we have debt. So that's good. Okay, now here in 2011, our total liabilities divided by our total stockholders' equity was $1.14 of debt for every $1 of stockholders' equity. So we had more debt than what we had equity. So that wasn't nearly as good. As far as if we wanted to get more loans to jump on some kind of great opportunity, we would have less chance to do so in 2011 than now. Our debt is real low, and so any bank would be happy to give us another loan if we needed one to jump on some great opportunity. Also, if we come into some kind of recession or other economic downtrend, now with this lower debt, French Connection importers will be able to withstand that economic downturn a lot better than it would have in 2011. Okay, now part of the reason that we went so much better is the fact that the stockholders' equity went up. We issued common stock. So and we had higher retained earnings. So our stockholders' equity went up. In the meantime, our liabilities, especially our notes payable and accounts payable, went way down. So our numerator went down and our denominator went up, and so that was a double whammy to cause this wonderful situation that we have here. The price-earnings ratio, also known as the PE ratio, is oftentimes indicated in the Wall Street Journal and various other places. And just like the EPS, earnings per share, this is an indicator ratio that lots of investors use. For this formula, you take the market price, that's the stock price on, say, the New York Stock Exchange or any one of the other exchanges, the price of the stock, of that common stock, and dividing it by the earnings per share. So you have to first figure out what the earnings per share is. So in our previous slide, we learned that $10.64 is the earnings per share for 2012. So that $10.64 would go in the denominator. Then we would have to look up French Connections importers, what their stock price is on the New York Stock Exchange or whatever exchange they're sold on, and find out that price of that share. Divide it by the $10.64, and that would give us our price earnings ratio. A higher PE ratio means that investors have more confidence. In other words, we learned how the market price, the stock price, will go up if investors believe that there's a good future coming of good profitability, good liquidity, and good cash flows. Then they will drive that market price up. Even if the earnings per share is lower, there are other things that investors have confidence that this common stock is going to grow and go up for them. And so if we had the same $10.64 but a low share price, then even though the EPS might be considered fine, the fact that there isn't enough investors driving up the price makes it seem like investors out there don't have a lot of confidence in the fact that the future is going to look as good as this year. Maybe there's some kind of something that's going to happen that they think in the future that's going to adversely affect French Connection importers. And so if they had a low PE ratio, then investors would shy away, some of them, from investing in that company. Okay, so this ends our analyzing. There are plenty of other ratios and ways to analyze things, but this tried to go through a bulk of them, of the most common ones, so that as you analyze the Sage company and as you analyze for your paper at the end of the semester, then you can be able to take a look at some of these things for the next months as you choose the particular company each month that you want to do heavy research. You should be able to show that you've done some of these